Good day, everyone. For today, our group will report about the topic Evolution of Taxation in the Philippines.
Evolution of taxation in the Philippines. The power of taxation is one of the three fundamental powers of the state. Paying taxes is important to help the government fund their projects for the development of the economy. Taxation has been established by the government to promote and protect welfare of the people. It is necessary that government should provide the citizens' needs and what other people can provide. Through the power of taxation, government has the authority to impose burdens and charges upon persons, property, and property rights. On hearing the word tax, what usually springs to our minds are the images of infrastructures and projects that are beneficial to the welfare of the people. The main purpose of taxations to our country is to raise revenue for the services and income support for the community needs. Contributing your share as a good citizen greatly helps in the development of the Philippines as a whole. Taxes will usually go to funding health services such as social health care, medical research, and social security. Taxes are crucial because government collects this money and uses it to provide infrastructures, including roads, bridges, and one of the most important are the public services such as police, hospitals, and schools buildings. Taxation is a huge help to our country because without taxes, improvement of our country would be impossible. Pre-colonial period, the Philippines has a prosperous economy even before they were colonized by Spaniards. Barangay was the earliest form of government. It was an independent settlement consisting of 30 to 100 families, with a population that varies from 100 to 500 persons. Each barangay is ruled by a local paramount ruler called the Datu or Raja. In the midst of pre-Spanish times, Filipinos can be divided into social classes. These are noble, freemen, and the slaves. The nobles occupied the highest classes. Next to them were the middle class called freemen, and the lowest class was the slaves. During these periods, natives started paying taxes, but only freemen were required. The tax collected was called buwis or handog. Non-payment of taxes was already punished during this period. Studying the pre-colonial literature on the Philippines is important to preserve the culture and stories made by our ancestors. When we hear the word pre-colonial, the first thing that appears on our mind is the study of the past. When the Spaniards came, they only found communities with only 20 to 30 people. But when the barangays has started to establish, the community become bigger. Barangay was the Filipinos' earliest form of government that consisting 30 to 100 families, and each barangay was ruled by Datu, who also known as Raha. Some barangays were big. There is a one barangay that called Sugbu that are now called Cebu. Like other states, Filipinos were also divided into social classes. The first class was the noble class. Noble class were the educated and the privileged class. The second is the freeman class, also known as Timawa. They were free, they could acquire property, choose any job they want, can pick their own wives, and acquired a living. And the last one are the slaves, who also known as alipin. They are not exactly slaves, but they were indentured servants. There was a two type of alipin. The alipin na mamay was a servant that lived in their own little house on the property of their master, and the aliping sagigilid was a servant that lived around the house of their master. In the taxation, during this period of time, only freemen were required to pay taxes. Taxes are called buwis or handog.
Spanish period is the first tax collection of Spanish and Filipino signed by Miguel Lopez de Legazpi and King Tupas of Cebu on June 4, 1565. This was done to provide resources for the government project. Under this period, common taxes collected includes tributus or tributes, cedula, santuarium, donativo di Zamboanga, vinta, fala, encomienda, and excess taxes on certain products, industrial, documentary, stamp, and postal tax. These taxes can be paid either cash or in kind, full or installment basis. But most of the taxpayers prefer to pay in cash. These taxes are both imposed for native and citizen. Tributus or tributes were collected to support government and church operation. All individuals above 16 years old and 60 years old below are required to pay tributes. Paying tributes has a meaning like in Spain, the paying tributes as a sign of loyalty of their king. But because of widespread of abusing collection, the king abolished it in 1884 and the cedula was introduced as a replacement. Cedula is like ID. This is the proof that you are paying tax. This is also your identification card. It has to be carried by the person all the time. Polo is a force personal services of the natives, also known as polos or polistas. They will working for the government in couple of days. All native men are must to be part of polo. Malolos Republic 1899. When the Philippines Republic or Malolos Republic was inaugurated on January 23, 1899 in Malolos, Bulacan, with General Emilio Aguinaldo as president, various taxes were imposed. This includes the Chinese pool tax, railway, freight tax, and rental of post office boxes and more. This system of collecting tax for any transaction or property are mandatory. This is also the way of supporting the government.
American period 1898 to 1946. Internal Revenue Law of 1904. The law Internal Revenue of 1904 was created by the Philippine Commission and Bureau of Internal Revenue on July 2, 1904. Internal Revenue Law was able to repeal all old Spanish law, substitute in lieu of such taxes a system of internal taxation based largely on American policy. The internal revenue taxes that were collected was from the manufacturer, sale and consumption of articles of luxurious or optional use and minimum of revenue from other sources. The Internal Revenue Law of 1914 was able to broaden the scope of internal revenue taxes. These were number 1 on cedula tax, number 2 on documentary tax, number 3 privilege taxes on business and occupation, number 4 specific taxes on manufactured product, 6 tax on resource of banks, receipt, insurance company, and receipt on corporation paying a franchisee tax. Number 7, charges for forest products. Number 8, fees for testing and sealing weights and measures. 9, internal revenue including the income tax collected in the Philippine Island under law enacted by the Congress of the United States. And lastly, number 10, taxes on signs, signboards, and billboards. Commonwealth Act number 466 or the National Internal Revenue Code of 1939 was enacted on June 15, 1939. This act was promulgated to revise, amend, and codify the internal revenue laws of the Philippines. The sources of internal revenue taxes include number 1, income tax, 2, estate, inheritance, and gift taxes, number 3, specific taxes on articles, 4, privilege taxes on business or occupation, 5, documentary stamp taxes, 6. Mining taxes, and 7. Miscellaneous taxes fees, and charged namely on taxes on banks and insurance companies. Commonwealth Act number 466 provides clear provision on income taxes. Under the Act, there shall be levied, assessed, collected, and paid annually upon the entire net income received in the preceding taxable year from all sources by every individual, a citizen, or resident of the Philippines. A tax equal to the sum of the following. As we can see in the table, there is a table for tax to pay ranging from 1% to 44% per annum. There's also a table for total net income ranging for 2,000 pesos to 2 million pesos.
The Act provides for personal exemptions allowable to individuals such as: first is for single individuals. It is the sum of 1,000 pesos. If the person making the return is a single person or a married person legally separated from his or her spouse. So, for single individuals, only 1,000 pesos. The next one is for married persons or heads of family. The sum of 2,500 pesos. If the person making the return is a married man with a wife not legally separated from him, or a married woman with a husband not legally separated from her, or the head of a family, provided that only one exemption of 2,500 pesos shall be made from the aggregate income of both husband and wife when not legally separated. For the purpose of the section, the term head of a family includes an unmarried man or woman with one or both parents, or one or more brothers or sisters, or one or more legitimate, recognized, natural, or adopted children dependent upon him or her for their chief support where such brothers, sisters, or children are less than 21 years of age. So for married persons or heads of family is only 2,500 pesos. The last one is the additional exemption for dependents. The sum of 500 pesos for each legitimate, recognized natural, or adopted child wholly dependent upon the taxpayer. If such dependents are under 21 years of age and incapable of self-support because mentally or physically defective, the additional exemption under this subsection shall be allowed only if the person making the return is the head of of a family. Again, the additional exemption under this subsection shall be only allowed if the person making the return is the head of the family. So for additional exemption for dependents is only 500%. Then for this, taxes on corporation was also fixed by the Act. The Act provides that every corporation organized in or existing under the laws of the Philippines, no matter how created or organized, but not including duly registered general co-partnerships or compañías colectivas, a tax of 8% upon such income, and the like tax shall be levied and paid annually upon the total net income received in the preceding taxable year from all sources within the Philippines by every corporation organized, authorized, or existing under the laws of any foreign country. So, the taxes corporation was also fixed by the Act. It is written. And the Act also provides for the determination of net income, species the items included and excluded in the gross income. It is the written on the Act. So, included and excluded is the gross income and allowable deduction. It is important to know the net income and the gross income. The next topic is all about the net income. Net income means the gross income computed under Section 29 less the deductions allowed by Section 30. It means that net income is an entity's income minus cost of goods sold, expenses, depreciation, and amortization. In fact, and taxes for an accounting period. It is also Net income is also your take-home pay after taxes and other payroll deductions. Your net income is the amount on your paycheck. It's what's used to make your budget. So, it is your, of course, net income. As a person, we have net income if we are working. And the next one is gross income. Gross income includes gains, profits, and income derived from salaries, wages, or compensation for personal service of whatever kind in whatever form paid, or from professions, vocations, trade, business, commerce, sales, or dealing in property, whether real or personal, growing out of the ownership or use or interest in such property. Also, from interest, rents, dividends, securities, or the transactions of any business carried on for gain or profit, or gains, profits, and income derived from any source whatever. It also include income derived from any public utility or from the exercise of any essential governmental function accruing to the government of the Philippines or to any political subdivision thereof. So, for short, gross income is the amount you can earn before taxes and other payroll deductions. Good day, everyone. My name is Adrian Butol, and now let's proceed to another topic of American period 1898 to 1946 about exclusions from gross income. There are following items shall not be included in gross income and shall be exempt from taxation under this title. First is life insurance. Life insurance, it is the proceeds of life insurance policies paid to beneficiaries upon the death of the insured, whether in a single sum or otherwise. And also, it is not included in gross income and shall exempt from taxation because, as mandated in Section 32B1 of the Code, this means that any proceeds or benefits received from insurance policies should not be included in the calculation of your gross income and therefore exempted from taxation. But if such amounts are held by the insurer under an agreement to pay interest thereon, the interest payments shall be included in gross income, because interest is a part of gross income deducted and shall be treated as gross income. The second item shall not included in gross income and shall exempt from taxation is the amount received by insured as return of premium. The amount received by the insured as a return of premium or premiums paid by him under life insurance, endowment, or annuity contracts, either because during the term or at the maturity of the term mentioned in the contract or upon surrender of the contract. And it shall not be included in gross income and shall exempt from taxation because return of premium is a type of life insurance policy that returns the premium paid for coverage, and premium means to keep the policy in force just in life insurance. The third item of exclusion from gross income is gifts, bequests, and devices. The value of property acquired by gift, bequest, device, or descent provided. However, that income from such property, as well as gift, bequest, device, or descent of income from any property, in cases of transfers of divided interest, shall be included in gross income. And the fourth item is interest on government securities. Interest upon the obligations of the United States to extent provided in the act authorizing the issue thereof, interest upon the obligations of the government of the Philippines or any political subdivision. But In the case of such obligations issued after the approval of this code, only to the extent provided in the act of authorizing the issue, and it shall not be included in gross income and shall exempt from taxation. The fifth one is the compensations for injuries or sickness. It is the amount received through accident or health insurance or under Workmen's Compensation Acts as compensation for personal injuries or sickness, and also plus the amount of any damages received whether by suit or agreement on account of such injuries or sickness are also not included in gross income and shall exempt from taxation. The sixth item shall not be included in gross income is income except under treaty. Income of any kind to the extent required by any treaty obligations binding upon the government of the Philippines. The word income exempt also, it is not included in gross income by the word exempt. And the last item that shall not be included in gross income and shall exempt from taxation is miscellaneous items. Income of foreign governments received from their investments in the Philippines in stock, bonds, or other domestic securities, or from interest on deposit in the banks in the Philippines. It is not included in gross income first because of foreign governments. The second one is financing institutions owned, controlled, or enjoying refinancing from foreign governments. And third, international or regional financial institutions established by foreign governments. And the income also derived by the government or its political subdivisions. Income derived from any public utility or from exercise of any essential governmental function occurring to the government of the Philippines or any political subdivision. The next topic of American period that I will discuss is about the deductions from gross income. In computing net income, there shall be allowed as deductions. First is expenses or expense. It is the cost of operations that a company incurs to generate revenue. It costs money to make money. Some examples or some common examples of expenses are employee wages, payment to suppliers, equipment depreciation, and etc. The next one is interest. Interest is the cost incurred by an entity for borrowed funds. It represents interest payable on any borrowings like bonds, loans, convertible debt, or lines or credit. The next one is taxes or tax. It is a tax levied by the government on the earnings of a business and income of an individual. Income tax is considered as an expense for the business or individual because there is an outflow of cash due to tax payout. The next one is losses. Losses are a one-time removal or decrease in a business resource or asset. Losses result from the sale of an asset. We insert other than inventory for less than the amount shown of the company's book. Since the loss is outside of the main activity of a business, it is reported as a non-operating or other loss. The next one is bad debts. Bad debt expenses are generally classified as a sales and general administrative expense and are found on the income statement. Bad debts leads to an offsetting reduction to accounts receivable on the balance sheet. The next one is depreciation. Depreciation is used in accounting as a means of allocating the cost of an item, usually a tangible asset, or its like expectancy, and a depreciation expense has a direct effect on the profit that appears on a company's income statement. The next one is depletion of oil and gas wells and mines. It is a method of recording the gradual expense or use of a natural resources over time and allows for a deduction from taxable income to reflect the declining production of resources over time. The next one is charitable and other contributions. Charitable and other contributions are classified as expenses and are reported on the income statement as debits to the appropriate expense classification. The next one is the conditions under which a non-resident alien means the non-resident foreigners, individual may receive benefits of deductions. A non-resident alien or foreigners is a person who is not a Philippine citizen and does not pass the green card or substantial presence test used to determine tax status. Non-resident aliens or foreigners must pay taxes, income they earn here in the Philippines. And the last one is the pension trust. Pension trust is an expense to pay the employee in the future. Assets in the trust are dedicated to providing pension benefits to the plan members. The next topic of American period that I will discuss is about the items not deductible from gross income. In computing net income, no deduction shall in any case be allowed in respect of A. Personal, living, or family expenses. From this, home mortgage interest, medical expenses, contributions, and other personal expenses cannot be claimed as deductions for in our tax purposes. B. Any amount paid out for new buildings or of permanent improvements or betterments made it to increase the value of any property or estate. Letter C. Any amount expended in restoring property or in making good the exhaustions thereof for which an allowance is or has been made. Letter D. Premiums paid on any life insurance policy covering the life of any officer or employee or of any person financially interested in any trade or business carried on by the taxpayer, individual or corporate, when the taxpayer is directly or indirectly a beneficiary under such policy. By the word of policy, so of course, it is it is not deductible from gross income. And last one is the losses from sales or exchange of property. From this, in computing net income, no deduction shall in any case be allowed in respect of losses from sales or exchanges of property, directly or indirectly. The last topic that I will discuss to you guys is about the income from sources within the Philippines. Gross income from sources within the Philippines. First is the interest. Interest derived from sources within the Philippines and interest on bonds, notes, or other interest-bearing obligations of residents, corporate or otherwise. Interest, it is the borrowed funds and represent the interest payable on any borrowings. And the next one is dividends. Dividends, the amount received as dividends. How we explain this? For this, it is the gross income sources from the Philippines. First, from a domestic corporation. It is part of the domestic corporation. The second one is from foreign corporations unless than 50% of the gross income of such foreign corporation for 3 years, period ending with the close of its taxable year preceding the declaration of such dividends, or for such part of such period as the corporation has been in existence, was derived from sources within the Philippines as determined under the provisions of the section, but only in an amount which bears the same ratio to such dividends as the gross income of the corporation for such period derived from sources within the Philippines bears to its gross income from all sources. The third one is services or service. It is the compensation for labor or personal services performed in the Philippines. Services are non-physical and tangible parts of our economy, as opposed to goods which we can touch or handle. Services, the example of services such as banking, education, medical treatment, and transportation make up the majority of the economies of the rich nations. They also represent most of the emerging nations' economies. So, it is the gross income from sources within the Philippines. Not only in the Philippines, but also in the other country also. The fourth one is rentals and royalties. Rental and royalties from property located in the Philippines or from any interest in such property, including rentals or royalties for the use of or for the privilege of using in the Philippines patents, copyrights, secret processes, and formulas, goodwill, trademarks, trade banks, franchise, and other like property. And it is the amount someone pays you to use the property. After you subtract the expenses, you have the property. The fifth one is the sale or real property is the gains, profits, and income from sale of real property located in the Philippines. So we can provide a gross income by this sale or real property like gains, profits, and income from the sale of real property. The last one is the sale of personal property. And it gains profits and income from the sale of personal property as determined in subsection E of this section. Some examples of personal property is like car, refrigerator, furniture, jewelry, silverware, or stereo like that, and etc. are gaining profits and income from our personal property. And that is gaining some gross income or net income here in the Philippines.
Net income from sources in the Philippines. Income of residents in Philippines is taxed progressively up to 32%. Resident citizens are taxed on all their net income derived from sources from non-residents. Whether an individual or not of the Philippines is taxable only on income derived from sources within the Philippines. Gross income from sources without the Philippines. For a company, gross income equates to gross margin, which is sales minus the cost of goods sold. Thus, gross income is the amount that a business earns from the sale of goods or services before selling, administrative, tax, and other expenses have been deducted. Interest from any currency bank deposit and yield of any other monetary benefit from deposit substitutes and from trust funds and similar arrangements 20%. However, interest income received from a depository bank under the expanded foreign currency deposit system shall be subject to final tax at 7 and 1/2% of such interest income. Royalties 20%. However, royalties on books as well as other literary works and musical composition which shall be taxed at
reduced rate of 10%. Cash and or property dividend from a domestic corporation or joint stock company or insurance or mutual fund company and regional operating headquarter of a multinational company or share in the distributable net income after tax of partnership, joint account, joint venture, or consortium 10%. Capital gains from sale of shares from stock not traded in the stock exchange not over 100,000 in 5% and on any amount in excess 100,000 in 10%. Capital gains from sale of real property located in the Philippines and classified as a capital asset in 6% based on the gross selling price or current fair market value as determined by the Philippine Tax Authority, whichever is higher. Net income from sources without the Philippines. Income in Philippines is divided into the following three categories which are taxed separately as summarized below. Number 1, compensation employment income. This income is taxed at progressive rates on gross income after deduction of personal and additional exemption but without deduction for expenses. Number 2, passive income. This income, including dividend and interest, is subject to tax at 7.5%. Number 3, business income and professional income. This income is taxed at progressive rates on net business income after deduction of certain specified expenses. Income from sources partly within and partly without the Philippines, if any, shall be included in full as taxable income from sources within the Philippines in the case of gross income derived from sources partly within and partly without the Philippines. The taxable income may be the first computed by deducting the expenses, losses, or other deduction apportioned or allocated thereto and a rateable part of any expense, loss, or other deduction which cannot definitely be allocated to some items or classes of gross income, and the portion of such taxable income attributable to sources within the Philippines may be determined by process or formulas of general apportionment prescribed by the Secretary of Finance.
Let's proceed to another topic of evolution of taxation in the Philippines, which is the post-colonial to the present. In post-colonial to the present, there are many subtypes topic. First is the Presidential Decree Number 1158 or the National Internal Revenue Code 1977. The Presidential Decree Number 1158 or the National Internal Revenue Code of 1977 was enacted to consolidate and codify all the internal revenue laws of the Philippines. The code is the result of the codification of all tax laws dating back to the year 1939. Why? Why this code is the result of the codification of all tax? Because a substantial number of provisions were rendered obsolete by recent amendments as a product of enacted laws and decrees. The code was implemented to ensure the proper guidance of the taxpayers and for efficient administration on the part of the government. And it is imperative to adopt a consolidated tax code to integrate such mandatory laws and decrees and to harmonize their provisions, not only for the proper guidance of the taxpayers, but also for the efficient administration. The next topic or subtopic is the Republic Act Number 8424 or 8424 or the Tax Reform Act of 1997. The prior to Republic Act number 10,963 or the Train Law, the current tax system is basically outlined by the Tax Reform Act of 1997 or Republic Act number 8424. The law amended Presidential Decree number 1158, Presidential Decree number 1994, and Executive Order number 273. Otherwise, is also known as the National Internal Revenue Code. The code was implemented to provides for the organization and function of Bureau of Internal Revenue or BIR. Um, it sets out that the powers and duties of BIR and the powers and authorities of its commissioner, regional directors, and revenue officers. The remaining provisions pertain to the income tax, which are definition of terms, general principles, tax rates, and computation of income tax on individual taxpayers, corporations, estates, and trusts. And also, this code prescribes the accounting periods, methods of accounting, and other income tax requirements that taxpayer should comply. So perhaps the most significant feature in the code Republic Act number 8424 or the Tax Reform Act of 1997 is the income tax rates. So let's see the written on the table below. So the tax shall be computed in accordance with at the rates established in the following schedule. For not over 10,000 pesos is 5%. Over 10,000 pesos but not over 30,000 pesos is 500 plus 10% of the excess over 10,000 pesos. For over 30,000 pesos but not over 70,000 pesos is 2,500 at 15% of the excess over 30,000 pesos. Over 70,000 pesos but not over 140,000 pesos is 8,500 at 20% of the excess over 70,000 pesos. For over 140,000 pesos but not over 250,000 pesos is the 22,500 pesos plus 25% of the excess over 140,000 pesos. Over 250,000 pesos but not over 500,000 pesos is the 50,000 pesos plus 30% of the excess over 2,500, 2,050, 250,000 pesos. For over 500,000 pesos is the 125,000 pesos plus 34% of the excess over 500,000 pesos in 1998. The table was provided that effective January 1, 1999, the top marginal rate shall be 33%, and effective January 1, 2000, the said rate shall be 32%. For married individuals, the husband and wife itself is the subject to provision of Section 51D, and according to the Section 151D, shall compute separately their individual income tax based on their respective total taxable income, provided that if any income cannot be definitely attributed to or identified as income exclusively earned or realized by either of the spouses, the same shall be divided equally between and spouses for the purpose of determining their respective taxable incomes. The next one is the personal exemption for individual taxpayer. For purposes of this personal exemption for individual taxpayer is to determine the tax provided in Section 24A of this title. What is the written in Section 24A? In Section 24A, in general, purposes For purposes of determining the tax provided in Section 24A of this title, there shall be allowed a basic personal exemption amounting to 50,000 pesos for each individual taxpayer. Exemption allowed to estates and trust. And for single individual or married individual judicially decreed as legal separated with no qualified dependents is 20,000 pesos. For head of family is 25,000 pesos. And for the married individual is 32,000 pesos. So what is the purpose of the paragraph? In the case of married individuals, where only one of the spouses is deriving gross income, only such spouse shall be allowed the personal exemption, or let's say the husband or wife. And for the purposes of this paragraph, the term head of family means an unmarried or legally separated man or woman with one or both parents, or with one or more brothers or sisters, or with one or more legitimate, recognized natural or legally adopted children living with an independence upon him or of their chief support, where such brothers or sisters or children are not more than 21 years of age, unmarried and not gainfully employed, or where such children, brothers or sisters, regardless of age, are incapable of self-support because of mental or physical defect. So again, not more than 21 years old of age. And see the next one about the additional exemption for dependents. This topic shall be allowed an additional exemption of 8,000 pesos for each dependent not exceeding 4. The additional exemption for dependents shall be claimed by only one of the spouses in the case of married individuals. In the case of legally separated spouses, for this, additional exemptions may be claimed only by the spouse who has custody of the child or children, provided that the total amount of additional exemptions that may be claimed by both shall not exceed the maximum additional exemptions herein allowed. So, what is the purpose of this subsection of the additional exemption for dependents? The purposes of this subsection, a dependent, so first, let, let we know what is dependent. So, dependent means illegitimate. So, the purpose of this subsection, a dependent means illegitimate. Illegitimate or legally adopted child chiefly dependent upon and living with the taxpayer if such dependent is not more than 21 years of age. Just like in the personal exemption for individual taxpayer, not more than 21 years of age. So, in the additional exemption for dependents, independent is also not more than 21 years of age, unmarried and not gainfully employed, or if such dependent, regardless of age, as in incapable of self-support because of mental or physical defect. Okay, the next topic is the Republic Act number 9504 or 9504. Republic Act 9504 was enacted in June 2008 to amend certain provisions of the Republic Act number 8424 or the National Internal Revenue Code of 1997. Specifically, it provides for the income tax exemption on their taxable income of the minimum wage earners including their holiday pay, overtime, night shift differential pay, and hazard pay. In addition, the law also increases the personal exemption for all individuals to a fixed amount of 50,000 pesos and the additional exemption of to 25,000 pesos for each dependent, not exceeding 4. So the next one is the minimum wage earner. So what is the minimum wage earner? Minimum wage earner, it shall refer to a worker in the private sector paid the statutory minimum wage, or to an employee in the public sector with compensation income not more than statutory minimum wage in the non-agricultural sector where he or she is assigned. So it is according to the Section 22 NIRC. And also, such statutory minimum wage rates are exempted from income tax. The Train Law, which is the RA 10963, likewise exempts the holiday pay from income tax. The Train Law mentions that MWE shall be, or the minimum wage earner shall be exempt from payment of income tax on their taxable income, provided further that the holiday pay received by such minimum wage earners shall likewise be exempt from income tax. And I have some example about the minimum wages in the Philippines in the year of 2020. So, minimum wages in Philippines expected to reach 537 pesos a day by the end of 2020, according to the Trading Economics Global Macro Models and Analytics Expectations. So that's all for the minimum wage earner. And now, let's proceed. The last one is about the allowance of personal exemption for individual taxpayer. Actually, there are some report for this, but this is my report for also about the allowance of personal exemption for individual taxpayer. First, A. In general, for purpose of determining the tax provided in Section 24A of this title. So, I already mentioned this Section 24 in this previous topic. There shall be allowed a basic personal exemption amounting to 50,000 pesos for each individual taxpayer. And also letter B, additional exemption for dependents.
Republic Act No. 10963 or the Tax Reform for Acceleration and Inclusion Train Law. On December 19, 2017, President Duterte signed Republic Act 10963 or the Tax Reform for Acceleration and Inclusion or Train Law. The tax program overhauls the country's 20 years old tax. This is the first package of the Comprehensive Tax Reform Program or CTRP of the government. The law will provide hefty income tax cuts of the majority of the taxpayer and at the same time raise additional funds to support the infrastructure project of the government. It also imposes higher taxes on cars, fuel, tobacco, and some sweetened beverage. Personal and additional exemptions enjoyed under previous tax law were also taken away by the Train Law. The Train Act is aimed to generate revenue to achieve the 2022 and 2040 vision of the Duterte administration, namely to eradicate extreme poverty, to create inclusive institutions that will offer equal opportunities to all, and to achieve higher income country status. It is also aimed at making the tax system simpler, fair, and more efficient. Income tax rates. Tax schedule effective January 1, 2018 until December 31, 2022. Not over 250,000 pesos, the income tax rate is 0%. Over 250,000 pesos but not over 400,000 pesos, the income tax rate is 20% of the excess over 250,000 pesos. Over 400,000 pesos but not over 800,000 pesos, the income tax rate is 30,000 pesos plus 25% of the excess over 400,000 pesos. Over 800,000 pesos but not over 2 million, the income tax rate is 130,000 pesos plus 30% of excess over 800,000 pesos, over 2 million but not over 5 million, the income tax rate is 490,000 pesos plus 32% of the excess over 2 million. Over 8 million, the income tax rate is 2,410,000 plus 35% of excess over 8 million. Tax schedule effective January 1, 2023 and onwards, not over 250,000 pesos, the income tax rate is 0%. Over 250,000 pesos but not over 400,000 pesos, the income tax rate is 15% of the excess over 250,000 pesos. Over 400,000 pesos but not over 800,000 pesos, the income tax rate is 22,500 pesos plus 20% of the excess over 400,000 pesos. Over 800,000 pesos but not over 2 million, the income tax rate is 102,500 plus 25% of the excess over 8,000. Over 2 million but not over 5 million, the income tax rate is 402,000 pesos plus 30% of the excess over 2 million. Over 8 million, the income tax rate is 2,202,000 pesos plus 35% of the excess over 8 million. For married individuals, the husband and wife subject to the provision of Section 51 shall compute separately their individual income tax based on their respective total taxable income, provided that if any income cannot be definitely attributed to or identified as income exclusively earned or realized by either of the spouses, the same shall be divided equally between the spouses for the purpose of determining their respective taxable income. The minimum wages earned as defined in Section 22 of this code. That minimum wages earned as defined in Section 22 of this code shall be exempt from the payment of income tax on their taxable income, provided further that the holiday pay received by such minimum wage earners shall likewise be exempt from income tax. Positive and negative effects of train law. Positive effect. The law generates more revenues for the government, which will fund priority projects and programs of the government like free tuition in state universities and colleges, conditional cash transfers, health care, the build programs, and rehabilitation for Marawi. When the government earns a lot of money, they can do more programs just like free tuition in college and other programs that can help people. The second positive effect is those earning below 250,000 pesos were from tax exempt and are not required to file income tax. While the negative effect is tax reduction is rendered useless by the enormous increase in the taxes imposed on goods, basic commodities, medicines, electricity, and fuel. The increase of fuel will have domino effects on price of goods and services including fare hike. If the price of fuel increases, also the price of goods and fees also increases. The other negative effect is the labor sector will surely demand increase in wages, which will also add to the cost of manufacturing goods and the delivery of services. In the first row, the positive effect, reduction in income tax leads to more money to spend on basic commodities like grain, electricity, oil, beef, etc. On the other side is the negative effect. It increased the price of sweetened beverage, caloric sweetener, high fructose corn syrup, and non-caloric sweetener. On the second row, the positive effect is the law also exempts medicine for diabetes and high cholesterol and hypertension from VAT. On the other side is the negative effect. It increased the price of vehicles due to increase in automobiles excise tax. On the third row, the positive effects, the law simplified taxes for small and micro taxpayer with the payment of flat tax of 8% on gross sales in lieu of income and percentage taxes. On the other side is the negative effect. It imposed 5% tax based on the gross receipts derived from the performance of services, net of excise tax, and VAT on invasive cosmetics procedure, surgeries, and body enhancement. On the first row, the positive effect is dollar tax and estate tax were reduced, while the negative effect is documentary stamp tax (DST) was increased except from property, savings, and non-life insurance. The positive effect is decreases and the negative effect is increases. The second row is the positive effect. It modifies the value added tax VAT and made it fairer after it repealed 54 special laws that provide non-essential VAT exemption. On the negative effect, there are two. The first one is excise tax on mineral products and tobacco was increased. On the second is increased tax rate on passive income such as interest, foreign currency deposits, royalties, prices, and other winnings from the PCSO are not tax exempt. The law took effect on January 1, 2018. The train aims to make the Philippine tax system simpler, fairer, and more efficient to promote investments, create jobs, and reduce poverty. When the positive effects decrease and when the government earns more revenue, they have more projects that can be done to help the people. But when the negative effect increases, all the goods increases and also the car fare is also increases.